Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on May 16th, 2022. A reminder, we have trading tomorrow at 11 Eastern Daylight Time. I want to go over the results from last week, a brief discussion of the market, and I want to pick apart from an investment perspective. Please remember that word investment. From an investment perspective, the trade we put on StarBUX. So last we closed that Starbucks trade that we put on. We closed it early. Very successful trade in a very, very, very short period of time. 0.6% rate of return. And of course, that recreates, because we closed it in just a couple of days, that creates an elevated rate of return on an annualized basis, which is how we measure all trades. Last week's income was very large, just like the week before. We have probably, based on history in this service, we have more positions open than some of us would care for, but that in turn generates larger amounts of cash. And we're still within the capital guidelines that I like to use, the capital allocation guidelines. So last week, the potential annualized rate of return was 50%, which is extremely high. The goal, of course, is about half that. And that also reflects a larger number of open positions. We extended some positions and roles. And for those of you who are new and listening to this, we measure ourselves on cash. We measure ourselves on annualized rates of return, the cash divided into our capital. And a roll generating cash for us is as good as the success of a new trade. And you can see we did a really large amount of business, if you want to describe it that way, by selling calls on our shares. Now, when you're managing a position, that of course grinds down your cost basis. Your screen may be saying we bought it at 50, we have a cost basis of 49, the stock is at 45. Oh my, but that's not a loss. We have the position open, and that $49 cost basis after a week may be 48, after another week may be 47, and so forth and so on. The market, let's take a quick look. Is support at 4,100 broken? It's a good question. We went way down below that temporarily, a couple of days, and then we had the big spike on Friday back to 4,000. So now the question is support of 4,100 really broken? We'll know by the middle of this week. If we're not back to 4,100, you can't really consider after a week being a support level for short-term trading. So the question now is, what does 4,000 mean? Is it just a big fat number, or is it a support level, or is it a ceiling? Market's a little wobbly this morning before the open and hovering around the 4,000 on the S&P level. I did a bunch of reading this weekend. I hope you did the same. And one of the things that became very clear was there was some amount of spillover from the crypto meltdown last week, including a couple of cryptocurrencies that theoretically are pegged to the dollar that it's called a peg. It's always going to be valued, at least it's going to trade like a dollar. No, it didn't. They were broken, bounced back. What impact did that have? Well, on speculators and day traders and weekly traders and even some hedge funds that have put crypto into their portfolio, this could have caused a massive margin calls. This could have caused a real need to liquidate equities. We don't have financial data. We don't have a regulatory structure. We don't have a reporting data in any way, shape, or form that tells us the impact of crypto on bond and equity markets. I'd be curious, someone does a PhD 10 years from now pulling this apart. But my sense is, if you look at the timing of the meltdowns and the meltdowns in crypto and the sell-offs in equities, they're linked. And maybe we'll know more in the coming days. And the other question, of course, overhanging the market is what impact will continuing movements by the Fed in the area of interest rates have, and exogenous geopolitical events have on the market. And speaking of which, the three big questions: are we now headed for a recession because of interest rates? Some say yes, some say no, some say muted growth. We still have a very hot housing market. We still have a shortage of cars. The Fed's change in interest rate is not going to change the purchase of cars. It may slow down. It has slowed down the refinancing of mortgages, but except in some selected, what you would call boomer or retirement areas, the hot housing market for people doing their first home, flipping to the second home because of a family, finally getting out of an apartment, that market has not changed. We have stalemate in Ukraine, and the stalemate has actually shifted over towards the Ukrainians are beginning to pick up ground in eastern Ukraine, and the question now in the market for people, professionals hedging, does this mean Putin will react more violently? Sweden and Finland are on the verge of coming into NATO in some fashion. What does that mean? And that's an overhang. And of course, in the real world of shipping goods and manufacturing things, and not just financial markets, what is going on in China? Continuing lockdowns and continuing almost aberrant behavior on the part of authorities, putting fences around buildings so people can't leave, the arrest of a 94-year-old Catholic cardinal in Hong Kong for newsletter. There's a brittleness to what's going on in the political situation in China, and that's spilling over into lockdowns and continuing efforts to open up, yet more COVID reports in certain regions. And the bottom line is this is an overhang on the market. It's also an overhang on everything from computer chips to refrigerators that requires something coming out of China to be manufactured in final form. Now, Starbucks is actually a canary in a coal mine for China. They said that in 225 of their regions in China, which is their second largest market outside of North America, there are lockdowns. And so it does impact business, and yet again, we went ahead and we traded it. So the stock itself over a number of weeks and actually months has been hit hard. The number one was Howard Schultz and the end of stock buybacks. And what I mean is Howard Schultz is the founder of Starbucks, long-term CEO. He came back a couple of months ago, kind of a surprise to people. And given the way the CEO he replaced left, my belief, it's a belief, it's not been stated by the company, is there was a massive stock buyback plan in place, and yet the company is looking at reconfiguring many locations, closing hundreds of locations and opening hundreds, not equal, closing more than opening. But the new ones will be more spacious. They'll be designed for drive-through. They'll be designed for takeout, meaning there are some takeout kiosks now where you can't even sit. And the bottom line, it's a response to the pandemic. That requires capital. And my belief is that Howard Schultz and the board said to the current CEO, go take a nice package and go away. We're not buying back stock. We are reinventing the company for the post-pandemic world and the next pandemic when it happens. Speaking of the pandemic, you have that overhang in China that I mentioned, and every week or every month you hear about a company relocating, partially relocating, changing supply chain. This, in some sense, would be a tremendous opportunity for us if it wasn't in slow motion, but it is in slow motion. You can't relocate a certain level. You can make socks anywhere, but you can't necessarily assemble iPhones anywhere. And so these are the things that affected us, but it also affected Starbucks and affected the stock price. There's concerns about a recession, and there are concerns about unionization, and there are concerns about labor costs. Well, let's go through those. In China, whatever you may think, the lockdowns are clearly temporary. So the sell-off in stock concerned with lockdowns is traders. They're not investors. And remember, a couple of minutes ago, I said, let's view Starbucks as an investor. Should be looking at Starbucks. Recession, historically, the stock has outperformed its peers. And many of you have heard the story that I knew the gentleman a long time ago in the 80s, late 80s, during a recession, who had a Wise potato chip franchise in the Maryland area. And I said, business must be hurting because at the time it was the most expensive goodie of that sort. And he said, oh no, my business goes up. People may not go out to dinner, but they treat themselves to a nicer lunch. And this has borne itself out with Starbucks sales throughout every downturn. People treat themselves to the extra latte, the pumpkin latte, whatever. They skip something bigger, but they give themselves little treasures during the day. And so the fears of a recession, which have hit many certain stocks, really should be boosting companies like McDonald's and Starbucks. Unionization has only happened in a handful of stores, and the company is embracing what employees want. They already started a $15 minimum wage. They already started with a college program and so forth and so on. And they're upping their game in this to head it off. And it's more about headlines in a few stores and headlines that the union is thinking of suing, because they're saying Starbucks is not doing this for our employees, that they're doing for the rest of the country because they're unionized. That's the law. Once a union has a site, you have to negotiate anything you do concerning wages and benefits with that union. And even if there's a company-wide mandate for 17 an hour or whatever, you have to negotiate with the union for that. So these are headlines for a trader, not for an investor. And if you put it all together, yes, it's a short-term downturn. Yes, the downturn could continue. But from an investment point of view, China's temporary. Recession's wrong. The unionization issue is a headline issue. And labor costs are going to go up, but they're in much better shape compared to a fast food place that might be paying $8 an hour, and so forth and so on. Oh, anecdote, I've been on the road, and I saw my first ever ad for a McDonald's, big marquee, now hiring people at the age of 14, which is legal in many places. It was legal when I was growing up in New York. So with all of this in mind about investment, let me go to the first rule of selling puts. When you sell a put, you must be willing to own the shares, especially in this service. I receive many emails of people who are new, and they're going, I didn't know we accepted shares. You need to look at the training program. You need to listen to these updates. And the point is, if you're out on margin and you have to accept shares, the margin terms are far less favorable for many brokers. It can be a real issue in how you manage your capital. Please be aware, at some time or another, 5, 6, 7 out of 10 positions, we may own shares for a week, we may own them for a quarter. It's all about cash, it's all about rates of return, and it's all about, from an investment point of view, not a trading point of view, never taking a loss, ever, on a really good company that's seeing a temporary downturn in its stock. So since we trade, but like investors, Starbucks to me is a really cheap stock, a tremendous company and a market dominator. And this is why I was very comfortable recommending a put despite the chart. And so here was the trade. You can see it. The current stock price, everything. We were pretty nicely out of the money. We were sold to 67, which is $5.50 out of the money. And we had a very nice potential rate of return. And this was to be an 11-day trade, not a 4-day trade like you often see. And we had a target return of 0.9% with a target annualized return of 29. Now, the target return for all initial trades theoretically is 32% annualized. But I was assuming, and maybe we don't articulate this in the alerts, we do articulate it in the live sessions, and I hope you can join us, it's 32% because I was assuming I was going to close early. And when you close early, those rates of return go up. So you take what the market gives you, so that we juxtapose that below average 29% target rate of return, hoping to close early to get us back to north of 32%. And so we did. We closed out the trade in a few days, and the stock had gone up, not dramatically, but had gone up enough that we could buy back the position for a very reasonable price. So we collected 59, we spent 17. So we had $59 a contract coming in, 17 going out, $42 profit per contract in just 4 days, not the original intended 11 days. So the absolute rate of return goes from 0.9% to 0.6. But the annualized return, potential 29%, becomes 57, because when you see the calculation in the training materials, but simply put, of course, when you compress a trade, we calculate annualized returns the way Wall Street does. They trade 7 days a week in various markets, so everything is based on how many days you're in the trade to calculate that return. At 57%, it would have been foolish to leave money on the table given current market conditions. And even thinking like an investor, you tell yourself, I'm out, I'm taking my money, I'm going to get a cup of coffee at Starbucks, I'm going to come back, maybe I trade it again in a few days. So to that point, market volatility has to dictate not how we pick stocks. Market volatility dictates how we trade, sell puts, and sell calls on those stocks. It's a big difference. There's not a lot of volatility right now in drinking coffee. There's certainly